The Chicago Business Barometer had a positive start to the third quarter as it jumped above 50 to the highest since January. This after having spent 2 months in contraction. Recent weakness has sounded a few alarm bells over the resilience of the U.S. economic recovery, although these have faded somewhat as firms reported solid increases in both production and new orders. The barometer itself increased 5.3 points to 54.7 in July, led by a double-digit gain in production and accompanied by improvement in new orders. The other three components, order backlogs, supplier deliveries, and employment, while up, remained in contraction. This took some of the gloss off of this month's improvement. Still, we'd expect to see some lag in these elements, especially employment. Companies reported strong revival in output in July after 5 months of relatively weak business activity. Production increased sharply by 12 points to 61.8, the highest since January, helped by a bounce back in inventory growth. New orders also increased to the highest since the start of the year and are running at levels back above the average of the past 12 months. Whether the other three components play catch-up next month is yet to be seen, but for now they are languishing below the 50 break-even level. Employment improved only modestly and remained in contraction for the third consecutive month, rising only slightly above June's 5.5-year low. Order backlogs rose sharply but remained in contraction for the sixth consecutive month, despite the increased level in new orders in July. The relative slack in recent months appears to have allowed firms to turn around orders quickly. Supplier deliveries were little changed and continued to hover just a shade above June's 2-year low. It was perhaps too early for the recent fall in crude oil prices to be reflected in the survey results. Either that or core pressures are on the up. While there may be some truth to the latter, the small increase in prices paid to further above the 50 break-even mark and to the highest since December may well prove short-lived. Responding to a special question, most companies reported that wage growth was pegged at a low level. 40% of respondents said wages had grown between 1 and 2% over the past year, while 19% said wages were up 3 to 4%, and nearly a quarter of the panel said wage growth over the year was unchanged.